past corrections look like missed opportunities, except the current one. With that as the theme, welcome to our Zoom web series hosted by One Tree Hill and PMS Cart on the Juggernauts, conversations with uncommon and curious fund managers. Hi everyone, my name is Jai and I have with me today Rajesh Kothari from AlfAccurate Advisors. Rajesh comes with close to or more than 2 decades of experience and has also previously been the fund manager at the erstwhile DSP BlackRock Mutual Fund. Welcome Rajesh to the Juggernauts.
Hi Jay.
One of the things that we like to dive into is what we call a machine gun 15. Quick fire round of questions to, get that adrenaline flowing, your creative juices, and hopefully you'll have as much fun as we do. So if you are ready, I'm happy to fire away.
Wow, I think it's going to be exciting because this is the first time in 10 years where somebody is taking, coffee with Fin people with Jai, which is good. We are all yours.
Excellent. Ready?
Absolutely.
Super. Which sectors do you think will lead the next rally?
I think the next rally is going to be much more broad-based. It is not going to be only one particular sector. Because when we talk about rally, we do not talk about 1, 2, 3, 4 months. We talk about 1 year, 2 year, 3 year, and 5 years. And I think over next 2 to 3 years, it is going to be much broader market rally.
Super. The question on everybody's mind right now, what is driving the market upwards? Is it liquidity? Are we seeing some sort of a panic buying? Because clearly there is not enough information that is apparent on the ground.
Well, I think, market is always, front driving is never a rear view mirror driving. On 23rd March, before lockdown was announced, Nifty hit 7,500 low, correct? Economy was doing fine. Everybody was working. You and I, we both were working in our offices, but market was 7,500 Nifty. And today, market is where we are, 20-30% higher from that level. And many investors, entrepreneurs, corporate, they are saying we are yet come back to normal. It is probably normalcy will come back by third quarter. So that's why markets is up, because it's going to be by third quarter. It is just 3-4 months away. So I think market is looking at FY22 and beyond, and therefore market is moving up, and that's how it should be. We need to remember, Jay, something very important, that this for the first time that the economic clock has stopped, but the financial clock has not stopped. It means that you have to pay rent, you have to pay wages, you have to pay salaries, you have to pay your fixed cost, and there is zero revenue. But that is for 1 month, 45 days, 60 days. That's it. When you look at the firm's value over the next 5-10 years, it is going to be very, very small component of the life of the firm. And therefore, it is a one time. Most of them believe that, of course, first quarter is wash out. 2Q is going to be better than 1Q, maybe 60-70% normalcy. And third quarter will be 70 to 90% normalcy.
Sure.
And fourth quarter is absolutely back to normal with some growth. Of course, there is a disclaimer that second wave of COVID-19 is not going to be as dangerous as first wave. So that's the assumption which everybody is assuming as well now. But normalcy will be back from third quarter onwards.
Okay. Will Bombay be under lockdown again?
I think what is more important is that markets are looking at not lockdown. As an economy, as a society, we are much more well prepared if the second wave of COVID-19 comes again. People are educated now, social distancing norms, medical infrastructure, the bureaucracy, the government, the medicine, globally. I think as a society, we are much more well prepared compared to our preparedness as on 1st March. So there is a significant difference in preparedness. And therefore, I think probably if the wave comes back again, the impact of that wave in terms of the preparedness is so high, and therefore the impact on economy will be definitely will be smaller than what we have seen in the first wave.
Okay, super. What is the next toil? Is it pharma or is it data?
I think data, and pharma also depends upon data. So data remains it was an input, It is input and will remain input.
Okay, so sure, sure. The stimulus from the government, how would you rate it? Good, bad, or ugly?
Say, within the given constraint, it's a neutral.
Okay. So a follow-up question to that then, Rajesh, is there a silver bullet sort of remaining with the government that they can use to, sort of activate our economy even faster?
Well, there is no free lunch. And therefore, it is a from one pocket to other pocket, you keep moving. So I think it is at a macro level, I do not see a significant room for government to spend. But of course, if they do it, definitely it will be positive surprise for all of us.
Okay, fantastic. If you had to go back in the last 6 months and sort of, tweak your philosophy a little bit, would you change anything in the past?
I don't think so. Absolutely, I don't think so.
So these are things that we'll have to, these are shocks that any portfolio will keep on dealing with. And as long as sort of you're sticking to your philosophy, you should be fine and at least stable.
See, well, I mean, if you say if 6 months back, if you would have known that COVID-19 is going to hit you, okay, and then if I ask you that after that you also know that market will then move 40% from the low.
You don't know that, but so.
So there are so many assumptions which you are assuming, am I right? You assume only one thing, but life is not like that. So I think 5 years back, let me put in this way: 10 years back in 2009, this is a counter question to you. 10 years back in 2009, if I would have told you that in 2020 there is going to be COVID-19, the biggest pandemic of the century,
Sure.
would you invest in any asset class? Your answer probably would be no. But in 10 years, Nifty, Sensex, good products have delivered you 10, 12, 13, 14% compounded returns even as on today after absorbing the impact of pandemic.
Do you follow a top down or a bottom approach?
It's a combination of both.
Okay. Okay. And just sort of putting it out there, of all the people that have come on the Juggernauts, only two people have said that it's a combination. Generally, one or the other is always favoring a bottom up or a top down to a very good degree. Rajesh, one aspect that no one knows about you.
Well, I don't know what to know about me. I'm not too sure, yeah. I think that's a difficult question. If you can ask me what I don't know about somebody, I can tell you. But what you don't know about me, I really don't know. Because
There's
then
something the market doesn't know about you.
I don't know because I don't know what market knows about me. Correct.
Okay.
So
Okay.
uh,
Let me rephrase it. A unique trait about you that very few people know.
well, I think your second part of question, I'm not too sure what people know and what people doesn't know because
Okay,
but
we can get back to that question at the end if you want.
probably I don't have answer to that question because
Okay.
then I have to assume that how much you know about me, am I right? So that is a very big assumption, and I think
Okay. Okay. Fair enough. Fair
it is
enough.
right to assume that.
Okay, that's fine. You're the first one to get away with that question, but I'll let you get away. Maybe we'll come back. Would you double down or double up on a stock?
Well, I think the definition of double down and double up is actually different. People look at stock price. I don't look at stock price. I look at valuations. Correct. So if you like the company and the valuations were good yesterday and has become cheap today with no change in underlying business fundamentals, you buy more. And even if the valuation goes up, but the earnings growth prospect have also become brighter, you may buy more. Correct. So, for example, let me give an example. A company called the largest auto ancillary company in India, Mothers and Sumi. Correct. The revenue of this company was less than 7,000 crores in 2009, and today it is 35,000 crore kind plus revenue. Correct. And we added position at every level. We bought it when it was 7,000 crore revenue. We bought it at 10,000 crore revenue. We bought it at 15,000 crore revenue. Correct?
Sure.
Because the valuations turn more attractive because the growth prospects become brighter and brighter during that journey of 10 years. So,
No, fair enough. That answers it. How would you rate the research on the street from a scale of 1 to 10, 1 being the lowest, 10 being the highest, the sell side research?
I think they are pretty good. I would probably rate them around 7.
Okay. Okay. Where in sort of in the space that we are in, and I'm going to ask you to broaden your horizon as much as possible. Where do you see the next innovation taking place for us?
Well, I think innovation is happening in front of our eyes. It is happening globally. It is happening every day. Say, for example, 3M India, a company, from the viewer's perspective, please put a disclaimer. We are owning this company for our portfolio clients.
Sure.
Is spending
That's okay.
6% of his, revenue every year. Every year, and they write it off. They don't do deferred revenue expenditure. If you
Sure.
do comparison of global companies, global MNCs, whether it is a companies like 3M, companies like Honeywell, companies like Timken, each of these companies are doing significant R&D every year, and that's the reason why it makes even the competition, kind of a pressure, because even competition need to innovate. So, for example, if you look at one more company like Britannia, look at the number of new product launches in last 3, 4, 5 years, and look at the contribution to revenue is increasing every year. So 10 years back, what Britannia was, and today what you get Britannia products in the market, there is a huge change. Am I right?
Right.
I think innovation is a constant theme. It is already happening in front of our eyes. We may not recognize it. It may not be very visible to all of us, but there are a lot of things which are changing this world. And
Superb. Rajesh, we've reached the end of the Machine Gun 15. I'm happy to say that, you come up with flying colors, and your sort of, coffee with Karan Hamper should reach you as soon as this unlocks more than anything else. But having said that, one of the questions that a lot of people are trying to figure out and hence participate in the markets is that how does while the sort of the lockdown was synchronous, right? Where one day we said that, look, the entire country, city, district is locking down. The unlock seems to be very asynchronous, right? Now consider whether it's a second wave that might come, hotspots that might develop across India per se. How do you see the unlock sort of moving forward?
well, I think it is extremely dangerous to predict such things. Nobody has any clue, including the medical departments and health departments of any government globally. What you need to look at is, don't get too much carried away by such things. Uh, Probably after 2 years, you and I will forget about COVID. It will become like a normal flu, and therefore keep focus on what you are investing. So it is like there are so many investors, they focus on economy, but at times, economy and market is no correlation, no one-on-one correlation. Last 5 years Indian economic growth or last 10 years Indian economic growth is not 12%, correct?
Sure.
It is not 9% real GDP growth. It's not. But market is delivered. So ultimately, you need to focus on the right sectors and right businesses and look at the firm's resilient business model. Then let's assume there is a second lockdown. Let's assume it. And let's assume it remains for 30 days. What happens to your portfolio company? Do you think they will shut down, or do you think they will gain more market share when economy opens up?
Right.
It is the character of the portfolio company that decides the resiliency of its business model, and that decides the market share and future growth for that particular company.
Superb, superb. And sort of, now, clearly your philosophy is very thought out in terms of, what you want in your portfolio companies. But if I could rewind it a couple of decades back, what was your first experience, sort of, with the stock market? Was it by chance? Was it something that, you were pushed into? Was your family sort of, in the stock market? How did you first get into this wonderful world of stocks?
Well, I think that I'm just the day on which I still remember. So we were in college, and being Gujarati, all Gujarati friends, and one fine day we said, why not we start investing in stocks? And then I called up my mother on that day, and I still remember that day. I called up from PCO. That time mobile was not there. I'm
Sure.
talking about the year 1991.
Okay.
91, 92, if I'm not wrong. I was in the first year of graduation, commerce graduation, F5 BCom. And I called her up and I said, Mom, I want to invest, 5,000 rupees in the stocks. And she said, yeah, go ahead, so no constraints, nothing. And that's where the journey started.
Absolutely. And, sort of, that's a very interesting way sort of you got introduced. and sort of, now I have to fast forward, 2 decades again. You run one of your very successful PMS at AlfAccurate, and it's one, at least on our website and our platform, one of the top rated PMSs. If I had to ask you to sort of pinpoint what is those 2-3 USPs or 2-3 edges that has made you all successful, and obviously not only successful from a performance standpoint, but you guys communicate a lot more with your clients. You guys have an active blog where there's a lot of understanding as to your thinking, etc. But what is that edge and what is that USP that you would like to sort of bring forward to make us understand what is that reason for success?
I think first and foremost, is focus on risk-adjusted returns. Focus is not on returns. Returns anybody can make. You can buy 5 stocks and you can become a millionaire tomorrow. Or maybe you can become zero tomorrow. So what is important is how you do your risk management. So for us, it is a protect capital, create wealth. We first put protect capital and then we put wealth creation. To us, wealth creation is important, but protection of capital is paramount importance.
Sure.
And in that exercise of protect capital, that's why the diversification, which we talked about, and very importantly, we follow very strong discipline exit strategies. So everybody talks and loves about what to buy. We focus, of course, on what to buy, but we also equally focus on when to sell. Because if you do not have disciplined approach, 75% of Sensex has changed in last 16 years. Today, there is not a single company, Dow Jones, which was there when Dow Jones was formed. And mind you, all the blue chip companies, correct? So MTNL, everybody forgets MTNL, but MTNL was a blue chip company in 1994.
Yeah, sure.
So business cycles keep changing. You need to monitor your portfolio. And of course, very importantly is what to buy. And then we have our very unique 3M approach, whereby we buy only the company which are leaders in their sectors.
Sure.
Of course, I don't need to mention the basic hygiene factor, the best governance management, financials, ROE, ROC. I mean, all those things are, of course, there. But very importantly, the leadership character of the company with a strong balance sheet and diversify across 40, 50 such companies to reduce your risk. And once you buy, put a very, very strong monitoring mechanism and follow a very, very disciplined exit strategy. And that is a constant thing for us. So it is a combination of these two things: 3M approach for stock selection, monitoring. You can put a pipe. Once you buy, put in the pipe, do monitor, and exit. Exit if you require. If not, you can continue to hold it for 10 years, no problem. But keep monitoring. The vigilance and diligence is very, very important.
Absolutely. And so sort of one of the things that has come out in what you just said, Rajesh, we've seen the last 2-3 years, or even the last 3-4 years, the PMS segment as a sort of function or as a structure has started to get a lot of funds, right? One of the reasons is that it gives obviously a very different boutique slice as to what a mutual fund cannot, right? And sort of just to pinpoint one thing, you said that diversity is obviously one of the key, which leads to risk-adjusted returns. But how would you then differentiate yourself compared to a mutual fund?
Well, I think it is not about differentiating versus mutual fund.
Sure.
Investor has a choice to invest in product A, B, or C, whether it is mutual fund, whether it is PMS, or whether it is AIF. Correct? He is not investing into PMS to take more risk. He's not there. His objective is not to take more risk. His objective remains the same, that anybody who can give me superior risk-adjusted returns, I'm willing to invest with them, whether it is a PMS, or whether it is a mutual fund, or whether it is an AIF. Having said that, we have one, of course, very strong USP in our firm, and that the founders are fund managers.
Sure.
So in mutual fund also, everybody is a great fund manager. They are very, very competent, but they may change their jobs. Whereas in firm like ours, at least in our firm, PMS firm, I'm a founder and I'm fund manager. And that's where I think that's the single biggest factor. If you ask me, the single most important differentiating factor is like a restaurant. Who is your chef? Am I right? If chef changes the restaurant, you don't visit the restaurant again. But
Absolutely.
if it's owned by the chef, you don't have that risk.
When we, what is, over time, I'm sure there are a lot of mistakes that you've made, right? Thankfully, I think I made a lot of them when I started my career, lost a good amount of my salaries, in stupid commodity plays. What is that one tuition fee that you can remember, sort of, which has had a significant impact on your philosophy, on you as a person, that the market has sort of taught you?
Well, I think thankfully, since my desire is never to be a hero,
Sure.
correct, the damage was always significantly lesser because we diversify across 55 stocks, 45 stocks, 50 stocks. Not a single company is more than 3% of the portfolio if it is mid or small cap. Not a single company is more than 5% of the portfolio if it is large cap. Each of our portfolio company is market leader. So what happens? And that doesn't mean you don't make mistakes. Mistakes is part of the market. You don't go right every time. But when you buy a leader and suppose something goes wrong in that company, it is not an overnight shutdown. You know, it gives you enough time to correct yourself. So say for example, earnings were driver of that company. Out of 4 tires, 1 tire is punctured. But
Sure.
see, there are 4 tires and it is not a bicycle with 2 tires. That's a concentrated portfolio. Here we have a 50 tires. 1 tire gets punctured and that too with a leader. Now let me give an example. Say for example, there is the largest, FMCG company and there is a significant product risk has happened in one of the product. But that product is 15% of their revenue and 20% of their profits. Of course, it is 20% is big, but 80% is still fine, correct? And
Right.
20% is not going to become zero. 20% is going to go down by 20%. So net impact is 4%. So you get time to adjust yourself. You get time to adjust your portfolio weightage. You get time to exit out of it if you think that another 3 years are not going to be good. And therefore, the damage is lesser. And that's the beautiful part of diversification. With less amount of tuition fees, you can still make wealth.
That's excellent to hear. And sort of, talking of adjustments that the company makes or the fund manager has to make, these are clearly difficult times for a lot of people, right? Have there been instances in your past as well where you have had to sort of, where you have questioned your style, had to make adjustments, or, to your style, your process, to your group companies, etc., or in the last, let's say, last 2 decades of your career?
Well, I think that is every day, not last 2 decades. I think every day, as an organization, we have a very, very, passionate people, passionate team members, very, very inclusive approach, very, very, what I would say, passionate, energetic, dynamic, and that's what drives your processes. So, as an organization, we are evolving. Even today, we are evolving,
Sure.
and if anything is to be learned from anybody for that matter, whether because every day we talk with one corporate, on an average, we speak with one corporate one day. And we have a lot of things to learn from them in terms of processes, in terms of reporting, in terms of customer service, in terms of how we make sure that we don't make same mistakes, in terms of how we make sure that we further improve our detailed eye when we are reading that annual reports and conference calls and due diligence and so on and so forth. So I think it is an ongoing journey, and that will continue. Because that's what the market is all about. So over the last 20 years, with the 25 years of experience, a lot of things, but market has taught you so many things. You become very, very humble. You say, yeah, I can go wrong.
Sure.
Very, yes, I do go wrong, and that makes you probably on your toes every day. And you say, okay, how we make sure that, in fact, what we do is that internally, we also make a process that which are the stocks which we have missed. So it's not about the stocks where we made money or lost money, but which are the stocks where you missed those opportunity, and what is the reason for missing those opportunities.
Sure.
So and I think that's where it's a lot of interesting things we keep doing, in house internally, and that keeps giving you more and more lessons every day.
No, and absolutely, and that sort of clearly comes out in sort of, as you mentioned, your risk-adjusted returns, which now there is a significant history of. But one issue that might also come out, because investment professionals are generally very passionate, right? Um, and I would like to believe quite emotional as well in terms of trying to better yourself sort of every day. In times which become difficult, how do you keep that emotional quotient sort of under control, right? How do you not get married to a particular stock, or how do you not? How do you recognize that you want to cut a bad stock but are unable to sort of cut it?
So I think more and more you become process driven, and it is a journey. It doesn't happen overnight, but over a period of time, you clearly learn more from it, and that's how you become more and more process oriented. You try to do stringent due diligence, and of course, in that process, at times you make mistakes. At times you do not buy the stocks which goes up 2x, 3x, 10x, and
Sure.
you get the pain because you feel that, oh, I'm underperforming because I'm not owning that stock, and still you hold on to that pressure. You don't succumb to that your investment philosophy and investment principles, and that's the only way by which you can deliver this. And believe me, it is a evolving process, and it still evolves, correct? Because knowing probably more than what you think probably one should also gives you some bias about a particular company. But when you look at history,
Hmm.
in last 20 years, in last 30 years, in last 50 years, every corporate, unfortunately, even if you look at globally, has some issues somewhere. One of the largest pharmaceutical company, Johnson& and Johnson, for example, they got a case against them, right? So what are we talking about governance and ethics? For Siemens, for example, for ABB Global, there are some charges, correct, for
Right.
against one company. So this governance ethics, you should keep in mind that you don't know from where you get a shock, and at that point of time, you should not be emotional about it. That, oh, this company is a leader and therefore they can't go wrong. You don't know. Volkswagen Global is a classic example. One emission norm scam, and stock goes
Yeah.
down 40%. And it's coming from a Volkswagen which is known for Porsche car family,
Sure.
but
Sure.
and that what keeps you more and more nimble about it, that you need to cut emotions, no love, no hate, and that's where the exit strategy, and that's
Absolutely.
that's critical.
Absolutely. Absolutely. And sort of, picking on one of the words that you mentioned, which is evolution, whether evolution for the fund manager, for the portfolio company, etc. I've been on the long short side as a fund manager in my previous job, and at least sort of talking on the same terms as you, that how should we improve risk adjusted returns to or magnify risk adjusted returns. And we obviously used our mandated to use a lot of options, a lot of futures to try and go short, etc. uh, in our opinion, there's a debate which is sort of bringing up or coming up, that should that option be given to fund managers in a manner where they can execute it in a right manner, obviously communicate to their clients that they will be doing it with some portion. Right now, we've seen PMSs generally be long only. Very few, if any, significantly try and increase risk adjusted returns through the use of futures and options. Are you a proponent of that, or do you think it should be a pure long only, and try and stick to sort of the long short part in the AI structure?
No, nothing wrong about it. Depending upon one's own competence, one can build accordingly. Not that strategy cannot work. The strategy can work provided you know how to make it work. The only constraint, in the past we have evaluated such things, particularly during events like election outcome, is it like
Sure.
binary outcome, and in last 10 years, whenever we have worked at such kind of a mechanism to do it, the IVs in India are typically extremely high,
Sure.
and therefore the price what you to pay for it
Right.
is extremely high,
Sure.
and therefore, at least as on now, therefore you think that probably it is not worth doing. But as the cost comes down, the IV comes down, like the global market, where you can hedge against anything at a fraction of price, then
Correct.
of course, then definitely one can explore that option. But we have tried a couple of times in last 10 years in PMS, because there were 2 times election outcome, there were 1 or 2 times global election outcome. But at every point of time, whenever you want to do that, the odds are extremely high.
Correct. Absolutely.
Like
Absolutely.
you are paying roughly 6 to 7% of your portfolio. You have to just compromise because of that put options, and then it makes you wonder that are you that bearish on market? Let's assume that event happens. Do you
Right.
think you will make so much money that even after paying 7%, you will still able to protect 10-20%? And the answer to that was no. And surprisingly, to your surprise, let me also tell you the outcome. If you would have done that option at that point of time, then probably it's better that we have not done it, because then we did post-mortem analysis that if you would have done it, then what would have been the performance? And
Right.
thankfully, we didn't do that because
Okay.
otherwise it would have impacted significantly.
Super, super. And I think that's one of the best answers that we read. We've got that. Look, if you have a strong portfolio, it's better to manage that portfolio rather than try and add more wheels to an already complex mechanism.
So what I tell to investors who propose such strategy, I say कि अगर आप बेच भी सको ना अपना स्टॉक, शॉर्ट तो दूर की बात है, अपना स्टॉक अगर आप बेच भी पाओ ना तो भी बहुत बढ़िया काम हो जाएगा. Short is one more layer to it, but
Absolutely,
जो
absolutely.
लिया है वो कम से कम बेच भी दिया ना, you made your good money out of it.
Fantastic, fantastic. Rajesh, we've almost come to the end of this. Just one question. There have been a lot of fund managers, advisors, investors, etc. Who probably started investing, taking client money, maybe in the last 6 months or a year, right? They obviously seen a much higher roller coaster than anybody else. You obviously come with so much experience. You've been running your own PMS. What would you say to such people, or what is the sort of the one advice that you would give to these individuals right now?
You mean investors or
Investors, advisors, or fund managers who sort of are almost are in the same boat and who have started recently.
okay. I think very important is select the right client. That's very, very important. When you propose anybody the equity as a product, like what we do it, we always tell them few important things before we onboard the client. The one, are you ready for volatility? Number two, whether money is for 5 years or not. You may see 20% negative returns. Are you comfortable with that or not? If
Sure.
answer to these three questions is yes, then only please invest with us. Otherwise, please do not invest with us.
Right.
Very
Right.
important. Because at the end of the day, we are trustee of somebody's money and it is their hard-earned money of investors. Correct? They need to have a peaceful sleep.
Sure.
And we also have a peaceful sleep. And which is very important because we are founders, correct?
Sure.
We are not, just salesperson. We are founders. And it is our extremely high responsibility to make sure that mindsets and mandates are very, very clear from day one.
Sure. Sure.
Having said that, if one looks as on 31st March 2020, the Nifty has delivered roughly 1% compounded 5 years. So some investors, for example, in the market, when you meet a lot of investors and a lot of equity guys, they say, why do we into equity as an asset class? Market has given you only 1% CAGR in 5 years.
Right.
But they don't look at it that way, that it is despite such a huge pandemic, which is happening once in a century event, market is still gave you 1% CAGR. It is not minus 30, correct?
Sure.
And if you take that as an opportunity, and then just look at Nifty 5 years down the line. So we have done some numbers here. In last 20 years, there were 6 times. As on 31st March, there were 6 years where market gave you negative returns on 12 months basis.
Sure.
And whenever you have invested during that time, market gave you 15% compounded in 3 years.
Sure. Sure.
So the point is greed and fear. correct? So you need to be greedy when everybody is fearful. And we need to be a little bit fearful when everybody is greedy. And if you can do that, I think you can make more than what everybody is expecting from equity as an asset class.
Oh, fantastic. On that note, Rajesh, thank you so much for your time. We've unfortunately reached the end of this conversation. Uh, it's been, I think there are enough gems in this conversation, which I will take back and implement it for my clients as well. Here's wishing you and your clients, everybody at AlfAccurate, a great 2020 and a superior year for investing. Thank you
Thank
again
you.
so much for your time, Rajesh.
Thank you, Jay. Thank you very much and wish you all the best. And I'm sure you have many more new milestones to achieve over next decades. So wish you all the best for the same. Thank
Thank
you.
you, Rajesh. See you.